Yes, compounding shines in down markets. And what do I mean by that? You know, compounding knows no difference between the large investor and the small investor. In that sense, it's a really good equalizer. And for all intents and purposes, it doesn't do much more than, and this is a sarcastic statement, separate the rich, those who are rich, from those who are broke. Wow. Compounding. Understanding compounding means you're earning interest on your interest. Not understanding compounding means you may be paying it interest on your interest, let alone the principal amount. Einstein called compounding the eighth wonder of the world. He's a pretty bright man. So often people are a little bit confused about it, but we're going to delve into it, and then we have some resources we're going to share with you at the end of the presentation. So if this is a topic that you think might be applicable to some of your friends, I invite you to go ahead and share the Facebook Live, and then they can get in on it too and perhaps ask some questions, but I'd be happy to answer the questions either live or later on. And in a moment, we'll give you the website with a bunch of freebies to help you understand compounding even better. And what's good about that? There's nothing like punching in your own numbers. There's nothing like that kind of aha moment. And I've had them as a financial professional for 42 years. When I see the effect of compounding, it is so strikingly amazing that I'm completely slack-jawed. I am still completely surprised at the beauty of compounding. And I'm speaking of it when we're earning interest on our interest. So what do a bunch of investors often say when we talk with them about, well, if you had it to do again, I mean, life and or investing, and most people would relay in terms of life that they would have lived more with the experiences that they maybe had a taste of but didn't do enough of, or were on their bucket list but they still didn't get to them. But in terms of investing, we often hear, I just wish I would have started sooner. I wish someone would have told me right out of high school, right out of college, start saving a percentage of your salary, because I would be so much farther ahead right now. And I must agree that time is that which is so powerful with compounding. Now, some of you listening and watching are saying, I'm already 60, I'm 65, I'm already 50, it's too late for me. Well, I'm not going to take that as an argument or an excuse, right? Because unless you have a life-threatening illness, and some of you may, but for the bulk of us, we must look ahead at the longevity charts that have shifted very seismically since our parents were our age. And we're going to get to that in a future Facebook Live about how it is different now than that which our parents dealt with. So we have some additional challenges that we'll want to address. And as I say, we'll face that on a different day. But even if we're 65, we've got a plan for another 30 years of needing money. We run analysis to age 100, because even in a couple, I expect one of them has a very, very high chance and probability, especially if they reach age 65 without a big medical ailment, of reaching age 92 or more. So those are fun statistics, and we'll get to them, as I say, next week. But what I want to talk about now is that if we start early and keep our hands off of these monies that we are investing, then we have a very, very good likelihood of amassing much greater wealth than we ever thought possible. Now, this has been played out in so many instances, but I was talking with a woman who said, I have some Pepsi stock. We were doing some fact finding, if you will. And I said, well, how much do you have? And she said, I don't know, I've just been investing like $100 a month since I was a kid. I just liked Pepsi, right? We looked at her statement because she was doing this automatic investing, this DRIP program, dividend reinvestment program. She had $62,000 worth of Pepsi stock. So we can talk about compounding working within like a certificate of deposit or some type of bond instrument where the principal fluctuation is either nothing, nil, or smaller, or we can talk about compounding with regard to stocks or equity investments whose principal value will over the long haul go up or have a high probability of going up. And it works the same way, but it gets magnified when the principal of the investment has the ability to grow. And that's important because inflation, while it's very low now, non-existent almost, it will start to creep up. And between now and 20 years from now, we're going to have some heavy-duty inflation. Believe me, all of this government spending is going to translate into inflation very swiftly. So it's going to cost us more to buy goods and services in the future, which is why we want to, put money away now. And the more we're able to put away now, the more we're going to earn interest on our interest. And what do I mean by that? So if we have a dollar bill, for example, and we put that away into a stock investment, right? And it earns, whatever, let's say, 10 cents, 10% interest, for example, and you're not going to get that in a money market and you're not going to get that in a week's time, but over time it might earn 10%. I don't care if it's 5 cents. The fact is you're going to end up with, at the end of the 1 year period, $1.05, right? And then you start the second year with that $1.05. And then all of that, not just the dollar, but the dollar and the interest earns money as you progress. And it's really ultimately the best way for us to save money because we don't have to put it all away ourselves. Like I've talked with people before and said, okay, well, to meet your goal, and some people say, well, I want to have $1 million by X number of years or this particular age. And I say, okay, great. If we're invested, can you afford $500 a month? And they're like, it'll be a little tight. So I'd say to them, well, you don't have to invest $500 a month because that's what it would take a traditional bond fund. That's the time it would take a bond fund to give you that $1 million. And again, I'm basing the historical averages for bonds and the historical averages for stocks, not knowing the future, of course. And beware of anyone who tells you they do from an investing standpoint. But basically, I say, if you can't afford $500, which would be the equivalent of what you would need to save each month in a typical bond fund, again, using historical return numbers, maybe you can afford $350, right? And if you invested that in a stock or an equity fund, you would get to the same number. And almost always people are cottoning to having to save lesser each month because it needs, of course, more or less, short-term sacrifice, right? So I want to talk about the long term. I'm not talking about the next 10 minutes. I'm not talking about the Dow yesterday and tomorrow and the Standard & Poor next week. I'm talking about saving for our futures, which I look at as 7+ years out. And in that regard, we can afford to save into equity-like investments or equity investments, individual stocks, or I much prefer mutual funds of stocks, So when people say, oh gosh, I wish I would have started sooner, I want to say, well, how about us start now, right? Or how about us increase what you're saving right now? Because I want to talk about results. I don't want to be in the victim role of, oh, I didn't save enough and I should have done it earlier. Shoulda, coulda, woulda, let's get out of the should pile. Let's commit right now to never being in a tight financial position ever again, because some of us know what that feels like, and it's not pleasant. So let's start now, and the rest can be very, very easy. Now, we do need to be patient with our investment program, like anything long-term, like a long-term relationship, for goodness sake. You're not happy with your partner every minute of every day. And so if you were making an analogy akin to the stock market, no, you've not been happy with that downward depression of the stock prices, or would we? We wouldn't be happy if we had to take money out of the market in order to pay our fixed expenses in the near term, but we might be very happy for the market to be down if we're investing in our retirement plan, whether it's employer-sponsored or our own IRAs. And what do I mean by this? We covered it earlier, but it's worth repeating, that if in fact you saved just $500, well, let's say this. Let's say you're saving $100 a month, okay, into or a pay period, into an investment that costs $10 a unit. So you're going to buy 10 units, right? 100 divided by 10 units. And then the price drops to $8. So the pundits on TV and everybody's veins are popping, neck veins are popping, the stock market is crashing, and the fund that you were investing in, it used to be $10 a share, now $8 a share. You look at your statement and you're like, oh, that's pretty bad. Like, well, is it bad? Because if you continue to save that $100 a pay, now at $8 a share, that same $100 buys 12.5 shares of that. And guess what? If we get a 50% correction in that particular price point example, and your $100 is going in at a $5 per share price, you got 20 units. And so we're going to build up units, and the units will compound, because if those individual shares spin off dividends and the dividends are still inside the plan, there's the interest earning interest on itself, coupled with the principal, of course. So that's what they mean when they say, you know, the golden goose lays a golden interest egg, right? You can't kill the goose. You can't take out the principal. And so I'll throw in a warning here. Please, no matter that the government has said you can take out to $100,000 of withdrawal out of your IRA or 401k, please avoid doing that at all costs. Because what I fear is, because the government made it available and panic sets in, that some of us have dipped into that retirement plan because of fear and panic, short-term panic. And all we're doing is kicking the problem down the road, because now what will we do in retirement? We've killed that goose that it will lay many, many more eggs. So we've got to be patient with our investments, especially stock market investments. It will work out for you, at least if history repeats itself. Every other market correction since we started measuring this in 1926, including the Great Depression, the markets have revived and gone even higher. And I implore you to search out every opportunity before you withdraw from your retirement plan. But let's quote Warren Buffett for a moment. He said, you know, I always knew I was going to be rich. So I was never in a hurry to. Wow. So that kind of plodding along. So let's get your interest earning interest. And so I'll give you some resources to help you get very clear on just how much an extra $10 of savings will help you in the long term. Now, what I want to talk about is the converse, because if we don't understand compounding, we're going to pay it, right? So I always say compounding works 24/7. It either works for you or it works against you. And if we might have amassed some credit card bills, I've had some people say, I'm going to use my stimulus check to pay off the credit card bill. Okay, that's an interesting start. And yet I am very interested in getting at the core of the pattern that caused the credit card bill to amass as an amount larger than that which you may have been able to pay on a systematic basis. So I really don't care the balance of your credit card, but I really want you to be able to pay it off at the end of each month. And if in fact you have had circumstances, and who of us haven't from time to time, where you amass a principal balance on a credit card, I can assure you that credit card company is in the business to make money, and they're going to make money off of your hard-earned dollars. And so it behooves us to be really diligent about going back and saying, okay, so if we have a $5,000 or $15,000 credit card bill, let's look back and remember it with our partner, if we're partnered, to see what was it that caused that amount of money to accrue in our credit card balance. And that is what I want to correct now. You know, someone said to me that you can't reap the benefit until you have learned the lesson, right? And so as painful as those credit card payments can be, and some of us are paying interest only or the minimum payment, and you can go on to any calculator and see how long it's going to take you to pay it off. Like a 30-year mortgage rate is really gross, but we'll also talk about that. I want to talk about how to use debt wisely. But for anybody that's carrying a credit card balance more than the 30 days after they have accrued those charges, that's the pattern that I want to get rid of, that excessive spending relative to our income. And so I want to correct that pattern first, you see, and that's where planning comes into play. We can't correct issues and we can't write our course without knowing how off course we are and how we got off course, right? So I'm not interested in blaming anyone for something that kind of happens and it continues to happen, and if we don't take a look at it, right, it's like anything in life, right? If your child starts to develop this bad habit or something that's not in keeping with how you would like the child to respond, and you just keep letting it go and letting it go and letting it go, you can't expect that to get better. So we need to stop the compounding of the negative, right? So we need to get to that root cause. Now, why do I spend so much time on this? Well, there's a whole bunch of statistics that abound about lottery winners. But you see, forget the stimulus check for a moment. That's $1,200 or $2,400, depending on kids and so forth and so on. I'm talking people that win groups of zeros. And the statistics gyrate. So Google it yourself and believe whichever source you want. But if there's too many statistics out there that shock me terrifically, and one of them happens to be that 70% of lottery winners are within 5 years bankrupt. Bankrupt. Another statistics say 1/3 of all lottery winners eventually end up bankrupt. This is unacceptable because the emotional cost, the relationship cost, I mean, the divorces, people hanging and killing themselves in despair at this. That's horrible. Horrible. So when people say, well, I wish I had more money, I want to say that's just silly, right? How much money do we need? And we're going to cover that next week in a Facebook Live. I want to get specific so that we have a target to which we will channel our very strategies to get to that goal and meet that goal and feel great about ourselves. And then that money that we will have saved and invested will buy us the experiences and the dreams, in addition to meeting our fixed expenses without us breaking a sweat. That's what I'm after. I don't care about 4% versus 6% versus a drop in the Dow of 18%. I don't care about that. What I care about is called life-centered planning, that your investments match and dovetail with your goals. And if your broker hasn't talked with you about your goals, but instead just jobs you with this stock or that bond or this stock or that private placement, I want to invite you to take a different look, to take a planning look, to integrate your finances, whatever they are, with your goals and run probability analyses to see how far off track, if you are off track, are you, and do that sooner rather than later, because then you can correct course. And that is so empowering. We love to help people live empowered retirements, and it doesn't happen out of chance. It happens because you make the commitment to that occurring. So the habits that we live with end up determining our wealth. Boy, how about that again? The habits that we live with, and it's a choice. There's a positive and negative to everything. Each moment we choose. Dr. Susan Jeffers' Pain to Power Continuum. How we hold our fear. We choose whether to be on the victim side. And we choose when we have enough strength or courage or curiosity or tenacity or some combination of all of that to move over to empowerment. So let's talk about an example that I think will blow your mind. It blew my mind, and it continues to blow my mind. It's a little example that almost every financial planner uses, but it's called Beth and Bill. All right, you can figure out any different names you want. They're 21-year-old twins. You know, of course, this is hypothetical stuff, but the numbers are what I want you to focus on. So Beth and Bill, twins, 21 years old. They just graduated college. Beth started saving $50 a month in an IRA, stock mutual fund. Okay. So an IRA means it's under a tax umbrella. So we don't have to worry about taxes, and nor do we worry about inflation, not worrying about anything, nor do we calculate inflation, right? So this is kind of pure compounding, dollar on dollar. We do, through the planning process, integrate the effect of taxes. We tamp that down as much as is legally possible, and we calculate in the effects of inflation. But just for this purpose of investment compounding, Beth starts saving $50 a month into her IRA, and she invested in a stock mutual fund, and she earns 10% interest. It's a round number. I'm not going to project that for future earnings on stock accounts, but let's just imagine, keeping the math simple, she earns 10% for the next 8 years. So $50 a month, bump, a bump, a bump, a bump. For 10 years, she saves into this IRA stock mutual fund. Bill, her twin brother, says, I'll get to that savings. And he doesn't start saving until age 29, so an 8-year gap. Then he gets the tip from Beth, hey, this fund's done pretty well. He starts to invest $50 a month in the same IRA mutual fund. And let's just say it continued to earn 10% annually for the next 37 years until Bill gets to be age 65. So you got it. Each of them were saving $50 a month. Beth started immediately at age 21. Bill waited 8 years. So all told, Beth has $4,800 of savings in this particular mutual fund. She puts her contributions on ice, and it just rolls 10%, 10%, 10%, 10% annually. Bill has invested now $22,200 because he has saved for 37 years. Now we fast forward, and I ask you, who has more money at age 65? Well, if you answered Beth, you answered correctly. She invested only $4,800, but she did so early, and that compounding worked miracles, and it gave her $256,650, over $250,000 out of $4,800, or dissect it even further, $50 a month. I dare you to come up with a budgeting exercise, and we covered that with Asta last week, that turns your budgeting into a game, and you start finding $50, $150, $175, $200 a month, and you can start this saving right now. Bill, if you're curious, had invested $22,200, and his balance at 65 was $217,830, excuse me. So I didn't do the math here, but $39,000, a cool $40,000 advantage to Beth. So see, it's not about being smart, except that in investing, and thanks be to God, both of them did invest, right? In investing and investing sooner, we're allowing that time to help us out on getting the monies that we're going to need in retirement. So I wanted to ask you to I'll just read off this example, which is on our resources page. If in fact we just started with a Roth IRA, so $6,000 into a Roth IRA, I don't need you to have any balance right now. Let's say you have zero balance in your account right now, and you're just going to start. You finally got it. You're going to start, and you're going to make compounding work for you. And you save $6,000 a month, a year, excuse me, which is $500 a month. And your investment earned 6% interest. Now, again, I'm going to make believe that there's no taxes and no inflation. So let's just call this in a retirement account, which $6,000 is your maximum contribution to a Roth this year. After 5 years, you'll have $36,029. After 10 years, $84,000, almost $85,000. After 15 years, $150,000. 20 years, $238,000. 25, $358,000. I'm rounding. 30 years, $518,000. 35 years, $735,000. And after 40 years, so if you're 20, you'd only be 60. If you're 40, you'd only be 80. 3 out of my 4 grandparents lived well into their 90s. After 40 years, just saving $6,000 a year, you have $1,028,000. That's the power of compounding, ladies and gentlemen. And the best way is to get started now, or to increase the amount that you're saving now. So I know that it's a time of uncertainty for many people's jobs, and I can empathize with that. And for those of you who do have a job, and the next raise you get, no matter when it is, I invite you to consider putting a goodly percentage of that raise automatically into that systematic saving. What could be easier in our lives than payroll deduction? Very little from an investing standpoint, very little. You know what people say to me? I missed it the first month. And then after the second month, it was just like, oh, that's my take home. And I don't know as you'll be any different. So take action, take corrective action. Let's make something really good. Let's make a good response to this struggle that some of us have been under, and some many more struggles than others. And I don't mean to be blithe about that. Yet there are those of us who can and must take this as a golden opportunity to continue to build our nest eggs, and then keep our hands off of it, right? Because the second you start to take away from the principal, that's going to be a downhill slope, and it won't be easy to recover from. Because if you do that, you've lost maybe a year or 2 or 3, and now you have to play catch up, see? So I could talk about this all day long, but you've got another drink to take because it's 5 o'clock someplace. So I invite you to come to our website, empoweredretirement.com, empowered, E-M-P-O-W-E-R-E-D, retirement, RETIREMENT.com/resources. And then you'll get a sense of these. It will give you about 3 or 4 calculators. We'll give you a chart showing you compounding. And remind yourself, annual compounding is interesting, but monthly compounding is so much better. Like you would have to have 5.119% annual compounding to make 5% monthly compounding to equal those amounts, right? So when you go into banks, like we used to be able to walk into the bank and we could see a little chart on the side, and many people looked at this from a mortgage angle. But if you have any money in CDs and you're just flipping the CDs, let's say your emergency fund is in CDs, for example, then you want to make sure that that bank is monthly compounding your balance. And if not, ask them why not, and maybe look at a different bank, because monthly compounding is so much more attractive than non-monthly compounding or annual compounding. So I think because we had a little problem getting the Facebook Live advertisement up, we don't have so many live comments, yet I will be happy to take any and all questions after the fact. So just email us, Debra, D-E-B-R-A, at empoweredretirement and the resources page will give you other ways to contact us. So I wish you well, stay healthy, and get compounding working for you. Let's better understand it so that we can earn with compounding and aspire towards meeting our goals, shall we? Until next time.